Welcome to the Investors Trading Academy talking glossary of financial terms and events. Our word of the day is equity multiplier. The equity multiplier is a financial leverage ratio that measures the amount of a firm's assets that are financed by its shareholders by comparing total assets with total shareholders' equity. In other words, the equity multiplier shows the percentage of assets that are financed or owned by the shareholders. Conversely, this ratio also shows the level of debt financing is used to acquire assets and maintain operation. Like all liquidity ratios and financial leverage ratios, the equity multiplier is an indication of company risk to creditors. Companies that rely too heavily on debt financing will have high debt service costs and will have to raise more cash flows in order to pay for their operations and obligations. Both creditors and investors use this ratio to measure how leveraged a company is. The equity multiplier is a ratio used to analyze a company's debt and equity financing strategy. A higher ratio means more assets were funded by debt than by equity. In other words, investors funded fewer assets than by creditors. When a firm's assets are primarily funded by debt, the firm is considered to be high leveraged and more risky for investors and creditors. This also means that current investors actually own less of the company assets than current creditors. Lower multiplier ratios are always considered more conservative and more favorable than higher ratios because companies with lower ratios are less dependent on debt financing and don't have high debt servicing costs.